Welcome to the deep dive. Today we're diving into basic economics, really fundamental stuff.
Yeah, we're using Thomas Sowell's book, Basic Economics, as our guide. It's a great resource.
Absolutely. And the mission here really is to get a solid grip on these core ideas without getting, lost in complicated jargon.
Exactly. It's about making sense of the economic forces that, well, shaped all our lives, whether we realize it or not.
So let's jump right in. The big idea, the starting point Sowell really hammers home is scarcity.
Right. It all comes down to this. Societies have limited resources. Materials, labor, time, you name it.
But these resources have alternative uses. You can use steel for cars or buildings or, I don't know, washing machines.
And economics is fundamentally about how we, as a society, figure out how to allocate those scarce resources, how we make those trade-offs.
It's not just money then, it's everything we value.
Precisely. It applies to consumer goods, labor, government policies. Everything flows from scarcity.
And understanding this helps you make sense of, well, why things cost what they do, why governments make certain decisions.
Yeah, it cuts through a lot of common misconceptions. We're hoping for some aha moments today.
Okay, so building on scarcity, let's talk about the role of prices. Sowell sees them as crucial signals.
Incredibly important. In a free market, prices are like the nervous system, transmitting information instantly.
Information about what?
About supply, how much is there, and demand, how much people want it. It's all packed into that price tag.
Okay, give us an example. The book uses ice cream and yogurt, right?
Yeah, it's a good one. Let's say people suddenly want way more ice cream than yogurt.
Okay, summer hits. Everyone wants ice cream.
Right, so ice cream makers need more milk. Their increased demand pushes the price of milk up.
Ah, but yogurt makers also need milk.
Exactly. So now they're forced to pay that higher price too. The price one producer is willing to pay affects everyone else who needs that same ingredient.
So it's like a bidding process. Scarce resources like milk get pulled towards where they're valued most highly by consumers.
Precisely. The value placed on milk for ice cream becomes a cost for yogurt makers, cheese makers, everyone. Resources flow to their most valued use, guided by price.
And this leads to efficiency, even without anyone planning it all.
That's the fascinating part. It's trial and error on a massive scale. Producers try to anticipate what consumers want.
If they guess right, they make a profit. If they guess wrong,
They lose money, maybe even go bankrupt. But the overall result for society is that limited resources get used to produce the things people actually desire most.
it's the system, not necessarily the individual brilliance of the producer, that drives that efficiency.
Right. The market mechanism, with prices and profit loss, pushes resources where they're most valued.
So it also calls prices a rationing mechanism, not like wartime rationing, but everyday rationing.
Yeah, because resources are scarce and have alternative uses, prices decide who gets them. Wages ration labor, interest rates ration capital.
And the price tag on a new phone rations phones. If demand shoots up, the price might rise.
Exactly. That rising price signals to consumers, maybe wait, maybe buy something else. And it signals to producers, maybe make more.
So price changes direct resources to where they're most in demand.
They help satisfy people's desires as fully as possible with the existing supply, dynamically.
And price fluctuations are normal, right? Not some deviation from a true value.
That's a key point. The usual price isn't more real than a higher or lower price under different conditions. Prices reflect changing realities.
He gives a really stark example of suppressing prices, the local famines.
Oh yeah, that really drives the point home. If you prevent food prices from rising in a famine-stricken area,
Then there's no incentive for anyone to bring food in from areas where it's more plentiful, even if people are starving.
exactly, food might literally rot on the docks because the price signal, the potential for profit that would motivate transport, has been shut down by controls.
It's a grim illustration of how interfering with price signals can have devastating, unintended consequences.
And conversely, declining prices also send important signals, like when cars replaced horses.
The price of saddles and horseshoes went down.
Right. Signaling that resources, labor, capital should move out of the horse and buggy business and into making cars or something else people now valued more.
Okay, so prices are vital signals. What happens when governments try to override them with price controls? Let's start with ceilings, like rent control.
Right. A price ceiling is a legal maximum price. Rent control sets a maximum rent, usually below what the market would charge.
And the immediate effect.
Well, the lower price makes more people want rental housing demand goes up. But landlords have less incentive to supply it at that low price supply goes down.
Creates a shortage, more renters chasing fewer apartments.
Exactly. But it gets worse over time. Landlords have less money and incentive for maintenance, so quality declines.
And crucially, there's less incentive to build new rental housing.
Right. Sowell cites examples from England, Wales, Europe, North America. Rent control often led to a collapse in private rental construction, except maybe luxury units with loopholes.
So it seems to help affordability short term, but long term, it shrinks the supply and quality of housing.
That's the typical outcome. And he notes that ending rent control, like in Sweden or Massachusetts, often sparked a boom in private building.
It's interesting that economists apparently overwhelmingly agree on these negative effects.
Yes, polls show strong consensus. But politically, well, there are usually more tenants than landlords.
So it can be popular even if it causes problems down the road.
And sometimes the benefits go to unexpected people, right? Like affluent tenants in rent-controlled luxury apartments paying way below market rates.
That's a classic unintended consequence, not exactly helping the people it was supposedly designed for.
Sowell also distinguishes shortage from scarcity. Rent control creates a shortage. Housing exists but isn't available at the controlled price. An earthquake creates physical scarcity. The housing is gone.
Like the gasoline lines in the 70s, that was a price control shortage, not a fundamental lack of gasoline.
Mostly, yeah. The controlled price was below what would balance supply and demand, so people rationed by waiting in line instead of by price.
Okay, flip side. Price floors, minimum prices, like agricultural supports.
Right. Setting a price above the market level, the government guarantees farmers a minimum price for certain crops.
And if ceilings cause shortages, floors cause.
Surpluses. The artificially high price encourages more production that consumers want to buy at that price.
So the government ends up buying the excess corn, wheat, whatever, to maintain the floor price.
Yeah, think mountains of butter or grain in storage. It's economically inefficient. You're subsidizing farmers by raising food prices, then maybe subsidizing consumers with food stamps to afford those prices.
Working at cross purposes economically, but Sowell says it can make political sense.
Definitely. You potentially please two different groups, farmers and food stamp recipients, even if it's inefficient overall.
And this happens in many countries, not just the U.S.
Oh, yes. Many industrial nations subsidize agriculture. These programs create powerful lobbies that fight hard to keep them. Think French farmers protesting.
So both ceilings and floors distort those crucial price signals.
And lead to unintended consequences, shortages with ceilings, surpluses with floors, and generally a less efficient use of resources.
Okay, let's tackle the greed explanation for high prices. People see a high price and just assume the seller's ripping them off.
It's a common, sort of intuitive explanation, but Sowell argues it's usually too simplistic.
Sellers can't just charge whatever they want, right? Otherwise, no business would ever fail.
Exactly. Competition and consumer willingness to pay put limits on prices. If you charge too much, customers go elsewhere or just don't buy.
Like his example of oceanfront homes costing more than smoggy inland ones. It's not greed, it's demand for the location.
Right. People value the ocean view and clean air more. That's reflected in the price. It's driven by demand, not just the seller's desire.
What about higher prices in poor neighborhoods? That often gets attributed to exploitation.
So points to studies showing profit rates aren't necessarily higher there. Often the costs of doing business are higher.
Costs like
Higher insurance, maybe more theft, delivering smaller quantities more often. These things add up and get reflected in prices. It's often systemic, cost-related, not just greed.
So focusing only on intentions, like greed, misses the systemic factors supply, demand, costs.
That's his point. Intentional explanations are easy, but systemic ones are often more accurate for understanding broad economic outcomes.
And ultimately, economics studies consequences regardless of intentions. A policy might be well-meaning, but what are its actual effects?
Exactly. That's the discipline, tracing out the likely results of different ways of allocating scarce resources.
This leads nicely into competition and innovation. Sowell stresses how dynamic markets are.
Constantly changing, companies rise and fall. He uses the A&P grocery chain example, once dominant, then faded because they didn't adapt quickly enough.
And profit and loss are the driving forces behind this constant adaptation and drive for efficiency.
Yes, both are crucial. The threat of loss is a powerful motivator. It forces businesses to figure out how to serve customers better, more efficiently.
It's not just about easy profits, it's hard work.
Very hard. Most new businesses fail. The pressure to use resources wisely is intense.
And a key advantage of this system, he argues, is how it uses scarce knowledge.
Yeah, knowledge that isn't widely shared. An entrepreneur with a better idea doesn't need to convince a central committee.
They just need to convince customers.
Right. If they offer a better product or lower price, their success signals the way forward. Like JCPenney building stores, while Sears stuck to mail order initially.
Penny didn't need Sears' permission. His profits showed he was right, and eventually Sears had to follow.
That's the market coordinating mechanism at work. Contrast that with central planning, like the Soviet Union.
Where planners in Moscow tried to figure out everything for the entire country.
An impossible task. Without price signals and profit loss feedback, they often kept producing things nobody wanted. Massive waste.
Because no single person or group can know all the local details, the changing tastes, the specific conditions across a vast economy.
Precisely. But prices convey that information automatically in summary form. They guide producers without needing explicit orders.
Okay, let's clarify profits, often seen negatively, like an overcharge.
Sowell defines it differently. Profit is the residual, what's left after all costs are paid. Wages, suppliers, lenders get paid first.
So the owner gets what's left over, if anything.
If anything, it can be positive, zero, or negative. That's the risk inherent in ownership. You're not guaranteed anything.
And losses are just as important as profits.
Absolutely. Losses signal that resources are being used inefficiently, that consumers don't value the output enough to cover the costs. They force change or exit.
He also mentions limits to company size, diseconomies of scale.
Yeah, beyond a certain point, bigger isn't always better. Coordination gets complex, bureaucracy creeps in, and efficiency can decline. That's why you often see multiple firms competing, not just one giant monopoly.
And the owner-manager role is active, not passive. Constant monitoring, adapting.
Right, especially in businesses with lots of local variation, like restaurants. Franchising is one way to keep that local focus and incentive while leveraging a larger brand.
Moving on to prices and efficiency more broadly, how do prices help resources find their best use?
Businesses seek profit by finding more efficient ways to do things. Like an oil company, realizing it's more efficient to sell gas to independent stations than run them all itself. Resources flow to where they generate the highest return by serving customers best.
And competition keeps everyone honest, pushing costs down.
In a competitive market, yeah. Numerous buyers and sellers mean individuals have little power to dictate prices. You have to be efficient to survive.
Prices reflect how much consumers value goods relative to their production cost.
They signal relative desirability and scarcity, guiding resources effectively.
What about monopolies, though? They seem to disrupt this.
They do. Monopoly restricts output not necessarily by deciding to produce less, but because their higher price means consumers buy less.
So resources that could have been used to make more of the monopolized good, if the price were lower, are stuck doing something less valued by society.
Exactly. It creates inefficiency. Resources are prevented from flowing to their most valued use.
And sometimes governments actually create barriers to entry that protect monopolies or limit competition.
Yeah, things like licensing restrictions, taxi medallions, limits on who can open a new airline or bank. These protect existing players but often mean higher prices and fewer choices for consumers.
He also talks about regulatory capture.
Right, where the industry being regulated gains undue influence over the regulators, so the regulations end up benefiting the industry more than the public.
Okay, markets also adapt over time. Assets move.
Yeah, poorly managed companies become takeover targets. Investors see potential to run things better, serve customers more effectively, and are willing to pay for that opportunity. Assets move to those who value them more highly because they can use them more productively.
And business models change too, like with urbanization. Mail order gives way to stores, small stores to supermarkets.
These shifts reflect changing customer preferences, population density, transportation costs. Businesses adapt to find the most efficient way to serve people under new conditions. Those that adapt thrive. Those that don't decline.
Let's revisit central planning versus markets, the British peanut scheme example.
A classic failure. Central planners in London trying to direct peanut farming in Africa, lacking the essential local knowledge of soil, climate, everything.
Which individual farmers, guided by experience and market prices, actually possess.
Exactly. Decentralized knowledge, coordinated by prices, is vastly more effective than top-down directives.
Plus, incentives matter. Profit drives efficiency in markets. Its absence leads to waste and planned economies.
When your own livelihood depends on using resources wisely, you tend to be more careful. State managers often don't face the same direct consequences for inefficiency.
And Sowell argues monopoly, while bad anywhere, is the norm under socialism because the state owns everything.
Right. Less pressure to innovate, improve quality, or respond to consumer demands when you don't have competitors snapping at your heels.
Okay, shifting to labor markets. How is pay determined? Sowell says it's about contribution to earnings.
Not just abstract productivity. It's about how much revenue an employee helps generate for the company. An employer won't pay you more than the value you add to their bottom line.
And the overall level is set by supply and demand for particular skills.
Yes, employers compete for workers, bidding up wages for skills in high demand and short supply. Ultimately, what consumers are willing to pay for the final product sets the ceiling on wages.
What about interventions like minimum wage laws? He uses Europe as an example.
He argues that higher minimum wages in some European countries contribute to higher unemployment, especially among young, less experienced workers.
Because if the mandated wage is higher than the value a worker currently produces, employers are less likely to hire them.
That's the argument. It potentially prices low-skilled workers out of jobs, creating a surplus of labor employment, similar to how price floors create surpluses of goods.
And union wage increases.
Can benefit members, but might also incentivize companies to automate more or lose competitiveness, potentially shrinking the industry and costing jobs long-term. Think coal mining or parts of the auto industry.
Let's talk inequality. Sowell is critical of how it's often measured.
Yeah, he argues that looking at fixed income brackets, the top 20%, bottom 20%, is misleading because people move between those brackets over their lifetimes.
And household size changes. Comparing household income over time can be skewed if households are getting smaller. Per capita income might be rising faster.
Exactly. Fewer people per household means even stable household income can mean rising income per person.
Also, work hours differ significantly between income groups.
Yes. Higher income households often have more earners putting in significantly more hours. That's a big factor in the income difference.
And there is mobility. People don't usually stay in the bottom bracket forever.
Studies show significant movement. Many people start lower and move up as they gain skills and experience. The picture isn't static.
He also makes the point that the poor often pay higher prices.
Due to the higher costs of serving low-income areas, smaller stores, maybe higher crime rates impacting insurance, etc. It's a tough reality.
Discrimination is another factor affecting economic outcomes.
Defined as judging people by group affiliation instead of individual merit. It can range from outright refusal to hire to channeling groups into different jobs or unequal pay.
But Sowell argues discrimination has a cost for the discriminator in a competitive market.
If you refuse to hire the most qualified person because of race or gender, you're potentially hurting your own business by hiring someone less productive. The profit motive itself pushes against discrimination.
But it might persist more easily in government or nonprofits.
Where the decision maker isn't spending their own money or directly facing the profit loss consequences, discriminatory preferences might face fewer economic penalties.
What about capital machines, equipment, and its relation to labor?
They complement each other but also compete. Businesses choose the mix based on cost. Rising labor costs can make investing in more capital, more automation, attractive.
And how efficiently capital is used depends on the economy. Wealthier countries replace equipment faster.
Because labor is more productive in alternative uses there, the opportunity cost of not upgrading is higher. In poorer countries, it might make sense to keep older machines running longer.
And job security laws protecting current workers
Can make businesses hesitant to hire new people, potentially reducing overall job creation and flexibility, even if it helps those who already have jobs.
Revisiting profit loss, downsizing, even in profitable companies.
Can be a sign of increased efficiency, doing more with fewer people. It's not always about being in trouble. Sometimes it's about getting leaner and more competitive.
Which connects to the fallacy of composition. What's true for a part isn't always true for the whole.
Right. Layoffs in one company or industry don't necessarily mean the whole economy is shrinking. Other sectors might be booming. You need to look at the bigger picture, the net effect.
Okay, measuring the whole economy, GDP and GNP.
Broad measures of total national output. GDP is production within a country's borders. GNP is production by a country's citizens' companies, wherever located.
But context matters hugely with economic data. The start year chosen can make a trend look good or bad.
Absolutely. Always ask compared to when. Statistics can be easily manipulated by choosing convenient start or end points.
Let's touch on money and inflation, gold's historical role.
Historically, tying currency to gold limited how much money governments could create, acting as a check on inflation.
Because inflation is like a hidden tax.
Yeah, when the government creates more money without a corresponding increase in goods and services, the value of existing money held by the public goes down. Purchasing power erodes.
And the speed money circulates, velocity matters too.
If people lose confidence and try to spend money quickly before it loses more value, that velocity increases and can accelerate inflation dramatically.
Modern banking fractional reserves also creates money.
Banks lend out most of the money deposited, creating credit, which functions as money. It expands the money supply beyond just physical currency.
And the Federal Reserve, meant to prevent crises, but
Sowell points out the worst deflation and bank failures happened after the Fed was created, suggesting managing the monetary system is incredibly complex and central control isn't foolproof.
let's broaden out to the role of government generally. Views shifted in the late 20th century.
Yeah, a move towards recognizing limits and potential downsides of excessive government intervention, partly fueled by the failures seen in centrally planned economies.
But government is crucial for providing a framework of laws.
Essential. Property rights, contract enforcement, these create the stability needed for investment and economic growth.
And basic social order, honesty, reliability matters too. Corruption is a major drag.
Hugely. Trust is fundamental to economic transactions. Widespread corruption raises costs, stifles investment, and hinders development.
Government control struggles with things needing local knowledge, like agriculture.
Yes, central planning is ill-suited for activities requiring timely, specific, localized information and adaptation.
And political incentives can override economic sense, like Nixon's price controls. Popular short-term, maybe, but economically damaging.
Politicians often respond to immediate pressures, even if the long-term economic consequences are negative.
Even economic measurement itself is hard. Indexes like the CPI are imperfect.
And when policies or contracts, like Social Security adjustments, are tied to imperfect indexes, it can lead to unintended wealth transfers or distortions.
Okay, international economics, comparative advantage.
The core idea. Countries gain by specializing in what they do relatively best and trading. Even if one country is absolutely better at everything, it increases total global output.
So international trade benefits everyone overall, even if some domestic industries face competition.
Yes, consumers get lower prices and more variety. Resources shift to more productive uses. Overall wealth increases, though there are transition costs for specific workers or industries.
Trade deficits aren't necessarily bad, could reflect a strong economy attracting investment.
Can be, yeah. If foreigners want to invest in your country, they need your currency, which they often get by selling you goods. So investment inflows can correspond with trade deficits.
Foreign investment itself is generally beneficial, bringing capital, tech, jobs.
Driven by expected returns, it typically benefits both the investor and the recipient country through increased productivity and opportunities.
But foreign aid, Sowell is skeptical.
He argues aid given government to government can be misused, prop up inefficient regimes, and may not effectively promote sustainable development compared to private investment.
And the unfairness of trade. Everyone imposes restrictions, but retaliation just makes things worse for everyone.
That's the point. Trade is mutually beneficial. Blocking imports might protect a specific industry, but harms consumers and overall efficiency. Retaliating against other countries' barriers usually just reduces trade further, hurting all sides.
Let's wrap up with some popular economic fallacies, non-economic values.
Often means wanting something without considering its cost, or the value of alternative uses for those resources. Refusing to acknowledge trade-offs.
Seeing economics as the obstacle rather than the framework for making choices under scarcity.
Right, and misunderstanding the market. It's not an entity, it's just the interaction of individuals expressing their values through choices.
Just identifying an unmet need isn't enough.
Need has to be weighed against cost and alternative uses. Resources are scarce.
And watch out for policies that save government money but cost individuals much more privately.
Need to look at the total cost, not just the government budget line item.
Economics is about trade-offs, not perfect solutions.
Always choosing between alternatives under scarcity.
Defining waste. Maybe using more of an abundant resource isn't wasteful if it satisfies desires better.
Efficiency is about satisfying human wants effectively, given the available resources and their costs.
Brand names aren't just manipulation, they save us time and reduce risk.
They economize on scarce knowledge, signaling expected quality.
And purchasing power can't just maintain wages if the underlying money supply or productivity has shrunk.
Trying to hold prices or wages artificially high in a deflationary environment just leads to unsold goods and unemployment. Prices need to adjust to reality.
Finally, revisiting business and labor. Adam Smith himself was wary of businesses seeking special favors.
Yes, he saw their tendency to try and limit competition or get government help at the public's expense. Urged skepticism.
Because while profits drive good things, businesses might try to avoid losses through interventions that hurt overall efficiency.
Losses are necessary for redirecting resources, but individual firms will try to avoid them, sometimes via politics, which can harm the broader economy.
The computer industry is a great example of dynamic competition, innovation, huge profits and losses.
Constant churn, rapid price drops, massive value creation for consumers, driven by relentless competition.
And nonprofits operate differently, without that bottom line pressure.
Non-profit and non-loss. The incentives are different, which can affect efficiency and responsiveness compared to for-profit firms facing constant competitive pressure.
So, wrapping this all up, these basic economic principles, scarcity, prices, incentives, competition, they seem simple.
But they have really profound and often counterintuitive implications for how the world works.
And understanding them is key to cutting through the noise and evaluating policies based on likely consequences, not just good intentions.
Exactly, focusing on trade-offs and results.
We've covered a lot, from rent control to international trade, trying to show how these ideas play out, hopefully some aha moments along the way.
Yeah, thinking about things like minimum wage effects or why trade deficits happen or how prices coordinate so much activity.
It's really just the start, isn't it? There's always more to explore, comparative advantage and depth, the nuances of government intervention, market dynamics.
But having these foundational concepts makes understanding the world around us so much clearer. It helps you analyze the news, political debates, even your own financial decisions.
Well, that's our deep dive for today, based on Sowell's Basic Economics. Thanks for joining us.